We've had a little bit of turmoil in the markets over the last couple of weeks, but we had this on the calendar before that happened. But I think that we can shed some light on what's going on in the economy and the market. I'm thrilled to have with me a couple of my colleagues that I think I'll introduce Jansen first because he has some legal disclosures that we need to go through before we get started. So over to you, Jansen.
Yeah, perfect. Hello, everyone. I get to play the fun role of added MC as well as compliance officer. So just a reminder for folks today, the information shared, we believe is sourced from reputable sources, or else we would not be providing it to you today. However, we cannot guarantee the accuracy of everything presented today. This presentation is not an offer to buy or sell or solicit for securities, should not be construed as individual specific investment advice. This is not customized for investment, tax, or legal purposes. Any opinions shared are the judgment of the presenters and are subject to change in the future as more data is made available. Additional information regarding the firms and their fees for all presenters can be found on their websites. If you would like to receive any of those materials, please reach out to me or any member of the Simmons or Stewart team. It's also available on all of our firms' websites. That's your fun compliance kickoff for the day. Don, I'll send it back to you.
Yeah, so let me introduce my co-hosts tonight. Erik Olsen's background spans numerous financial services roles, global business consulting, and quantitative research. He entered the financial services industry more than 25 years ago after developing a high-frequency trading strategy and has provided clients holistic wealth management for more than the last 15 years. He's currently assisting both Simmons and Stewart with the training of our advisors and our portfolio construction. Jansen is also serving at our firm. His financial services career also spans a number of different companies, including accounting, auditing, consulting, and operations roles. Prior to joining our firm, Jansen served as the CFO and COO of a $30 billion institutional investment management firm where he monitored numerous public and private investment strategies across the globe. Jansen is a CPA and he serves at our firm overseeing portfolio operations, back office operations, and regulatory and compliance matters. So thank you, Erik and Jansen, for being with us tonight. Now, our agenda for tonight is, maybe 45 minutes to an hour of content and presentation. I've broken it down into three areas. We're going to first talk about the economy, then we'll talk about the markets, and then we'll talk specifically about the investment portfolios and the implications for that. And I expect that we should have plenty of time at the end for some Q&A for people who don't fall asleep during the presentation. So with that, let's just hop in and talk a little bit about the economy first, and then we'll get into the stock market itself. So I actually haven't talked to Erik or Jansen in preparation for this. So I have a few slides, and then I know Erik has added some slides also. We'll see if we agree or disagree on where we think this economy is and where we think that it's going. In terms of just an overview, there's a lot of different data that we can look at, from construction numbers to job growth and manufacturing. It seems like most of those three areas are actually slowing. Retail sales and industrial production seem to be bringing some mixed news. The service sector also is cooling a little bit, especially because interest rates are unsteady at this point. I actually pulled up some headlines today just to see what other people were saying about the economy and whether we're headed to a recession or not. Bank of America's economist no longer sees the U.S. entering a recession, says CEO Brian Moynihan. He said that just over the weekend. While also last week, JP Morgan Chase economist warned that the odds of a U.S. entering a recession this year have increased. So we've got two big firms that stand on either side. One says they no longer see a recession in the future. The other one sees that odds of a recession are increasing. A couple other ones. This is from, I believe this was Morgan Stanley. The market is telling us there's a higher probability of a recession. Actually, that's from Invesco. JP Morgan recession outlook. As I said, they're expecting increased odds of a recession. Here's an article. CEOs no longer anticipate a recession, says the conference board. So the opinions are all over the place. I'm going to take a look primarily at some data around jobs, because this is an area that historically has been a good place to look at the leading indicators when there's softness in the economy. So the first one, the chart at the top, is the household employment survey, which slowed sharply in July. You can see the tail end of that there dropping significantly. That's generally not a good sign when people are saying that they're out of work. The Kansas City Fed Labor Market Conditions Index, which is the second chart, you may not be familiar with this, but this is one of the most comprehensive composite indexes of leading employment indicators. It utilizes a total of 24 different readings of the job market, including permanent job losers, the quit rate, job openings compared to unemployed, and more. And so this is one that we need to take seriously when the current line, which is the jagged one, moves below the 3-year moving average. That has historically been a pretty bad sign for the economy. So looking at jobs, I just think that we have some concerns of the economy itself. I can't remember what my next slide is, Jansen, if I've got one. Okay, I'm going to hand it over to Erik at this point to use some of these JP Morgan slides.
Yeah, and credit where credit's due. JP Morgan does a wonderful job of producing this guide to the markets, and I believe actually it's available to you as well as a non-professional. But nevertheless, I think it's just useful at a couple of levels to see some of the backdrop to what's going on in the general economy, and that's to look at what's taking place on at one level, government spending and government revenues, and the impact that deficit is having on growing the national debt. So on the left-hand side, you can see the 2024 federal budget is nearly $7 trillion of spending, $6.8 trillion of spending. But in order to make ends meet, they're having to borrow nearly $2 trillion, or 28% of what's being spent. Obviously, that's not sustainable, and yet it's been political suicide to try to address the underlying causes of that spending on the left-hand side. As you can see, the second tier down from the top is net interest on the debt. That is now nearly $1 trillion, $900 billion a year, to just service the borrowing that we've done in the past. And at this point, we continue to add to that. Eventually, one of the two things happens. Either the interest on the debt grows to such a level that it crowds out all other spending, or you just have to continue to borrow incessantly. There's a school of thought that was popular a few years back that was called modern monetary theory. essentially this said, if you are a country like the United States that has a dominant global currency, then you can spend as much as you want, and deficits and debt is irrelevant. Well, I would say that if you accept that at sort of smallish levels, at some point there's a moment where you have to confront the reality of the fact that the debt, that's the lower right hand grid here, has grown to beyond 100% of GDP. This has grown to beyond the ratio of national debt to GDP that prevailed at the end of the Second World War. And there was a reason for it then. There's much less of a defensible reason, I would argue, today. Next slide. There's a lot of conversation about interest rates. Interest rates, as you can see here, running from 1993 on the left-hand side to present day, and then a future projection into 25 and longer term on the right-hand side. This is a reflection of the actual up until you start seeing those dotted lines. And you can see the Federal Reserve brought rates to a pretty high level, the same level that was immediately preceding the global financial crisis of late 2007 and 2008. Good news if you're a borrower, bad news if you're somebody who's looking to get income off of a bond portfolio is that the forecast is that rates will be coming down over the next few years, probably by 2026 or thereabouts, maybe 2025. The projection is somewhere in the neighborhood of the low threes. So if you're thinking, my kids have not been able to buy a house or whatever the case might be, maybe there's hope for them in store in a couple of years, although it may be that housing prices continue apace. Next slide. Because that's all I have on the economy. I've got more on markets.
So
the only
Erik,
thing, Donna,
go ahead, Jansen.
The only thing that I think is interesting to add to this conversation when you look at the broad economy is I think Warren Buffett was trademarked for saying, don't bet against the American economy. Consumer spending is very interesting as an economic indicator. So I like to keep an eye on that one. Especially how is that spending utilized? What are people doing? How are people financing that spending? We saw during the pandemic, as people were staying home, there was some stimulus involved. The amount of outstanding credit card debt across the US right-sized. It had been growing, and it very much dipped. And we woke up in 2021 and saw a reality where, hey, the American consumer has a little bit of a safety net on average, which was a great thing to see. I looked the data from June was released late July, and the American public is $1.15 trillion back in credit card debt, which is a number that says to me that people are either spending perhaps a little bit more freely and comfortably. We did see salaries increase in the last couple of years, which is good. But as interest rates have risen, so have credit card rates. Usually seeing those numbers raise is a scarier sign in the marketplace, something that give us pause. Interestingly enough, when you look at that 1.15 trillion in credit card debt outstanding, the population that has seen the largest growth, both percentage-wise and total dollar, is Gen X. So folks that are in their 50s, late 40s through, I believe, late 50s, perhaps into the early 60s. Somebody can keep me honest on that. But it's showing signs that I think consumers are finding themselves. Inflation has been problematic, especially for the average household in the US. And so seeing Americans build more and more over the last year in credit card debt, I think is something that if and when consumers decide that enough is enough, they're no longer willing to utilize discretionary spending the way that they had in the past. Obviously, if they stop spending money, it's good for fiscal responsibility of the household, not super good for the US economy that's primarily built on an engine that says, we love the consumers buy things, and when consumers buy things, companies grow and their valuations on equities of those companies increase. So something that's a little bit alarming that I usually keep an eye on.
Yeah, I'll just dovetail with that, Jansen. The other things relative to the consumer is that during the COVID era with all the stimulus. Their war chest of liquid assets, basically savings, ballooned way out of proportion. I think it was a couple $1 trillion of excess savings. That has been virtually depleted down to nothing. And if you look at the most recent data on delinquencies of credit cards and auto loans, for about 9 months now, those delinquencies have started to increase. Those are two not so good signs relative to the consumer. So let me ask the panel real quick. Is the U.S. economy headed for a recession, a soft landing, a hard landing, or nothing at all? You have 30 seconds to respond.
Erik, lead us off.
Soft landing.
Wow.
My 30 seconds is that, and I don't know that we'll have time to get into elections. I don't believe that the president himself has much influence over the economy, but I believe that whoever takes office is going to be hit with a recession first quarter of next year.
I'm hoping for a soft landing. If that doesn't materialize, I'm concerned that the Fed's levers, which they are able to pull to help boost the economy, are not quite as extreme as they have been in the past. I think they've had more ability to reduce interest rates or use fiscal policy to support the economy in hard seasons. Yes, they can lower interest rates, not a ton from where they are today. So I'm hoping for a soft landing. If that doesn't materialize, maybe a more interesting season where we will be proud that we are well diversified in portfolios, but we'll get to that in a few moments.
Well, it seems like our team is on either sides of the fence the same way that Bank of America and JP Morgan are on opposite sides. The good thing about that from a money management firm is it means that we're positioning our portfolios really in preparation for both. So let's move into the market itself. Especially the end of July there, we had some pretty severe down days that caused people's hearts to skip a beat here and there. So let's just talk about what's been going on. I think you've probably all heard about the Magnificent Seven, the 7 stocks that have really been driving this market, the S&P 500, especially since about November of last year. These are the 7 biggest companies in the index. Their names you recognize, like Apple and Amazon, NVIDIA, Google, Meta, and Tesla. I think there might be 1 or 2 others. But those companies lost a lot in 2022. In 2023, they rebounded back. Most of them, though, were still negative until about October of last year. I think NVIDIA was the only one that was positive if you looked at the rolling numbers from before the decline in 2022. But since last November, they have marched forward big time. And what happened is that their valuations got, out of whack relative to the rest of the market. If we just look at the price relative to earnings, those 10 largest stocks were trading at about 30 times earnings. The chart here says 29.3 times, where the whole rest of the market, 490 stocks in the S&P 500, was trading at the more normal valuation of roughly 18. So what happened at the end of July with some shaky news on the economy, I think some investors also looked at these valuations and said, maybe we should take some profits off the table. The Magnificent Seven, as you can see, relative to earnings per share, the projections are that their PE ratios will revert back closer to the mean over time, back toward an 18 or so number. Actually, the Russell 2000, which has more small caps in it or smaller cap stocks, appears to look like it's going to be at a higher valuation. Did we skip the bottom of that previous slide, Jansen? No, I guess I just hadn't read it, but I think we covered all that. I can't remember. I think there's another slide or two here. So this was just a snapshot because I know people started calling on the phones. Are we in the throes of the beginning of a major correction or a bear market because there was a bad week? It's important to note that year to date, all the indexes still remain in very positive territory, and year over year numbers for 12 months. If you're in stocks really of any kind, you've seen some very, very nice returns. The next chart is a reminder that there's really never a year where there's not a pullback in the market. In fact, looking all the way back to 1980, the average drawdown in any given year is about 14%. I think I did the math. It was 14.3% is the average inter-year drop in the market. But you can see the blue charts, the blue bars here represent the upside of the market. The market, as you know, averages about 10% per year, but you don't get that if you don't participate in the downside. And you also have to participate when the market busts out. Another important statistic to note is that over these past 44 years, the market was positive 33 years out of the 44. The math is pretty simple. 1 out of every 4 years, the market drops in value. That's the statistic that I was taught in 1987 when I first got into this industry, that 1 out of every 4 years has remained consistent. Sometimes, like in the 90s, you get a whole bunch of good years and people think that things have changed, but I would still say the odds are better than Las Vegas. You have a 75% chance of the time you're going to make money, but you have to be prepared that 25% of the time the market is going to be down. And every year you have to be ready for this intra-year drop of what has averaged to be about 14% per year. So I think what we experienced and probably will continue to experience from now until the election is the frothiness that always comes in an election season and kind of in the August to October timeframe. The market seems to have these gyrations where people are trying to wonder about what the future holds. Can't remember what my next slide is. I think this is over to Erik.
Yeah, the 5 slides that I've got here, when we're talking about markets, I think it's useful, or for my way of thinking at least, is to have some touchstones that periodically you refer to set your expectations. And that doesn't mean that they'll necessarily be, they're 100% predictive, but at least directionally you can set your expectations. So one of these is the presidential cycle. And this may be correlation and not any sort of, it may just be randomness as compiled, but there is a fairly high consistency about the 3rd and the 4th year, at least in terms of the extent to which they're positive. And so we're currently, if it wasn't clear, we're currently in the 4th year, and the average returns over the entire period where this has been measured, going back as far as there are data, is that the 4th year has a return on average of 70 or 7.5%. But what's interesting is that the percent of years, the fourth year that are positive, is 75% of those years are positive. It's next year where it starts to get a little less certain. So the first year of the presidential administration, on average, is 6.7, but the number of years that are positive in there are only 58. And it's when you get to year two that it gets even a little dicier with the lowest return, and only slightly more than half of the years are positive. Year three, like we had last year, is the year that most people they're waiting for the big opportunities and the consistent returns that are in there. Next slide. Now, Don was just talking about price to earnings ratios. And of course, Don, you were comparing, and I think it's important to do as you did, to segment out the Magnificent Seven and the heady valuations that you see there versus the other 493 stocks of the S&P 500. This, though, is a dot plot on, or a scatter plot, I should say, about expectations about forward returns. Now, as you can see on the left, let's just first of all interpret what's going on here. On the left-hand side, the x-axis, which is down below, is the starting point, and that is whatever is the then prevailing estimate of forward price to earnings ratios. That is to say, there's as best as they can do. They try to project what the earnings are likely to be for the S&P 500 stocks collectively, and then they compare those to the starting valuations of those. So the price price is on top, and then the earnings projected is on the bottom. In this case, we're as of August 14th, yesterday, that was 20.7. On the left-hand side, the vertical axis is the projected forward return over that one next year. And what they've done is they've drawn that orange line through that. If for those of you that remember your college stats classes, that's a linear regression line. And so the central tendency here would be that you would expect a return that's probably low to mid single digits going forward. But as you can see, a one-year forecast is a really messy business, because in similar instances of a comparable forward starting PE, you've had returns that were as high as 40%, and you've had returns that were as low as minus 25. So that's not necessarily a super great guide. The right side, though, is taking that same principle and just extending it out 5 years. Here you see the dispersion of returns is much more compressed. And things do behave a lot more proximately to that line. And in this case, the same story is told, that on a compound 5-year annualized basis, when you start with valuations like we started with yesterday, then 5 years forward, it's much more likely the case that your historically, at least, your returns on a compound basis are below 10. So, and in some cases actually negative. So does that mean that you shouldn't invest with ambitiously or for growth? No, but it may mean that you want to diversify your portfolio more, which is sort of teeing up some of the conversation that Don and Jansen in particular will have in the portfolio section. Next slide. In this, the other way, sorry. And then here we go. Another way of setting expectations is to look at consumer confidence. What you'll see here, this is going back to 1971, and it's a monthly observation of consumer sentiment and or consumer confidence. And this is taken from a study that the University of Michigan does, month after month after month. What's the most recent reading, which we have for July, was that consumer confidence was at 66.4. This is on a scale that has ranged anywhere from 50 as recently as June of 2022 to as high as more than 110 back in January of 2000. What you see is this is a contrarian indicator. Generally speaking, the more confident consumers are, the worse that is as a forward or as a forward return from the market. So if you look at those above that average point of 84.6, look at some of those dots. I'm just looking from the left hand side. Yes, there's a -6. Yes, there's a plus 1.2, but 13.5, -2, 4.4, -4, -3, +20, -1, etc. Now look at the ones that are on the lower half. And there it's +22, +20, +29, +32, +14. Big numbers follow low consumer confidence on a 12-month forward return. So on this side, we're not at the lowest numbers, but we're by no means even close to the average at this point. So on this, at least, would bode fairly well for forward market returns. And then finally, the next pair of slides here is this is a 10-year look back on nominal returns. So these incorporate inflation. And what you're seeing here is on the left-hand vertical axis is the compound annual growth rates to these various asset classes, whereas on the x-axis down below is the amount of volatility that you had to accept to get that result. So on the left-hand side, lazy river, that little pink dot, USA, that's USA cash. On the far right is more whitewater rapids. And so generally speaking, we see lower returns are associated with more peaceful asset classes. Higher returns generally, the price of those higher returns is you're willing to accept a little bit more Pepto-Bismol in the kitchen, in the bathroom cabinet. So this is what I want to highlight here is what were some of the lowest returning instruments over this period? Well, they were commodities, treasuries. Just highlighting those. What were some of the highest returning categories? U.S. large cap, and then U.S. small cap. Now let's go to the next slide and say what the same research organization, Research Affiliates, is forecasting for the next 10 years. And now this is forecasts that are based on a particular methodology. This methodology is looking primarily at the current valuations as a guide to what comes next. Again, it's contrarian. In this case, if they're right, which asset class looks to have the lowest nominal returns? That means it includes the contribution that inflation makes. Well, it's precisely the opposite of what was on the previous slide. U.S. large cap stocks are the ones that get hit the hardest if this valuation model is accurate. And on the flip side, the ones that would be the highest returning would be international markets outside the U.S., the international developed markets, and even more than those would be emerging market stocks. Will they be right? Only time will tell. But it certainly does suggest that when we talk about portfolios and portfolio design, it makes sense to regularly be checking, is it time yet? Is it time yet? Is it time yet? To increase our participation in this asset class and pare down our participation in another.
So, I say to my clients frequently that what we do is not rocket science, but I'm glad to have somebody on my team who thinks like a rocket scientist, Erik. Great charts. While we may differ on the economy and recession or soft landing or nothing at all, I think you and I are in pretty close agreement relative to the market itself, because this is the kind of data that I would look at and say, I believe that everything does usually revert back to the mean. And so if you have one asset class like U.S. large caps that have just knocked it out of the park for a period of time, chances are going forward, they probably will revert to the mean and get lower returns for a period of time. Now, whether that means that we're going to see a major market correction, or do they get that by just having lower consistent returns? I don't think we know the answer to that, except I would say, from my perspective, and I'd like to hear from you, Erik, I believe that we can have a correction in the market, whether or not the economy goes into a recession. I believe that is possible.
Absolutely, I believe that's possible. I mean, let's just look at the most recent correction that took place, especially in the tech stocks. So people may be wondering, why did things suddenly plunge? The markets put in a high on July 16th. Why did things suddenly plunge? I think a big reason for that is something that we rarely think about here in the United States, but it's the use by some institutional investors, hedge funds in particular, of leverage. And if you're borrowing money to go then invest borrowed money, you're motivated to find the lowest interest rate you can find, albeit with a stable currency. Which country on the planet had both a pretty stable currency and the lowest interest rate possible? Japan and Japanese yen. And so when people started looking and saying, "Wait a second, the Japanese yen is strengthening. I borrowed Japanese yen and I went and I invested in US dollars, and now the yen is coming back against my position. This is starting to feel uncomfortable. I'm starting to feel like, wait, it's not just the interest burden that I'm paying. I'm actually losing money on the exchange rate shift." And so when people started watching that, they saw then a catalyst. The Japanese market overnight, a week and a half ago or whatever it was, dropped by 12%. That's the biggest drop on that market, I think, since the 1980s. And so suddenly people got rattled, and suddenly people started unwinding their yen positions. And to unwind their yen positions, they had to sell some of the things that they had invested in dollars, and that put pressure on U.S. markets. So does that mean that? So you can have a correction that has nothing to do with recession. It can just be with currency movements and practices of institutional investors.
Yep. Very good. Jansen, what do we have next?
Now we're getting into portfolio considerations.
Okay, so what are we doing about this in our portfolios? We've always believed that we need broad market exposure base and non-correlated investments. We'll talk about that in a little more detail, in a little more common language. We'll talk about what is alpha and how are we pursuing alpha in our portfolio, and some active management inclusion that we're also adding to the portfolio. So let's tick through these slides and just talk about our portfolios. If you've had a meeting with us in person in the last month or two, I've refreshed everybody's memories on this concept of correlation or non-correlation that we've talked about for many, many years. I've always used the illustration of a flower garden, that when Amy and I were first married, I heard about these things called perennials that you plant once and they come up year after year. I thought that's a great idea. So I bought hundreds of tulip and daffodil bulbs. I'll tell you, we had the best looking flower garden in April of anybody. But for the rest of the summer, all we had was a patch of dirt, because I didn't understand the idea of diversification or non-correlated flowers that would bloom in different months. So in the stock market, correlation or strong correlation is just a bunch of investments that all go up and down together. That's what we see on the left-hand side. On the right-hand side, a well-constructed portfolio needs to have things that are non-correlated, that go up and down at different times. So Erik's chart a couple slides ago, he pointed out that commodities were over the last, I think that was a 10-year period, the worst performing asset class. Well, this year in our portfolios, our 5% exposure to gold has been the best performing part of our portfolio, because that's a non-correlated investment. It doesn't go up and down with the stock market. We bought that really as a hedge against inflation, but it's also done very, very well when the market gets a little bit frothy and scary. The next slide, I think we'll talk about alpha. Nope. Did we skip alpha?
Nope. We'll just we'll get into some examples in a second. Go ahead and go on alpha.
So do you want to talk about the systematic trend? Why don't I talk about alpha, and then you can go back to those systematic trend things. So another concept that's really important in portfolio construction is this idea of alpha. Alpha implies moving beyond simply indexing. Through thoughtful index deviation, we seek to increase the fuel octane within portfolios. So let's, just like we use flowers for correlation, let's use octane as a way to better understand what alpha is. So when we go to the gas pump, we can push one of 3 or 4 different buttons. This is, of course, if you're not driving a Tesla, then this doesn't apply to you. But if you're running a gasoline engine, those 3 different numbers represent the octane. And the octane is just a part of the fuel that causes the combustion to act differently depending on the way that the engine is made. Most of us can't tell the difference whether we run 87 octane or 90 something in our normal cars. Unless you live here in the Northeast, maybe you'll notice a little bit of difference in the dead of winter, but the difference in the octane doesn't do much for an average vehicle. But if you're driving a NASCARs generally are running fuel that's 100 octane or higher, because their engines are made to have better combustion with the higher octane fuel. You're never going to see a NASCAR driver win a race using 87 octane fuel. So where octane allows the fuel to get better combustion in an engine for more horsepower, alpha is the same in a portfolio. It allows us to get a little bit more return above the index by doing something different than what the index does. If you just think of squeezing the juice out of an orange, this is a way to get a little more juice out of that orange. So beyond just indexing, which has always been a core part of our portfolios, one of the things that we're adding back that we had deviated from the last couple of years with more index-related products to reduce costs. I really believe that this is an opportune time to take some of the profits off of the table, those large cap stocks that have done so well, and start to migrate those to the areas that either haven't done that well, low correlation, or with some tactical momentum money managers who actively do something beyond just indexing. So that's the theory behind what we've always done in our portfolios, but we're making some strategic allocation changes right now to change our ratios. And Jansen can go into, I think there's a few slides on the specific products that we're using to do that.
Yeah, thanks, Don. And I like to think about it like building blocks. A good portfolio builds upon itself. You have those kind of base broad exposure products along the bottom of the base of the block tower. You want to be exposed broadly to the marketplace. It's very difficult to understand and guess which this stock, that stock, this one, that one, which one is going to do really well. So if you have broad exposure, that's a great base to start building off of. And then when you go from there, it's like, okay, where do we want to thoughtfully, as Don mentioned, deviate from just what the indexes are doing? And when we do those tweaks and have specific areas of focus that say, hey, the index is doing this, we're going to do a lot of that, but we're also going to zig over here a little bit. That's where you can try and get some of that alpha. And one of the ways in which we do deviate is through investing in what they call non-correlated investments. And here we're going to talk about one of the investments specifically that's in our portfolio now. Let's go back a few slides. And the thing that I think is really helpful for understanding, and there's some bigger terms on here like systematic trends. The idea is we're looking for, to simplify things, we want things that will zig when other things will zag. And a lot of people say, oh, yeah, I'm familiar with stocks, I'm familiar with bonds. And those are two big categories that people usually will balance. And we'll say that there's more things that you can include in the equation to allow you to zig and zag a little bit better in volatile markets like we're experiencing today. As you can see from this product that we use, they use a variety of different things to pick from as they're building that investment product. Yes, they have equities, both U.S. and global equities. Yes, they have the bonds and the fixed income products. They also have currencies. Erik very astutely brought up the Japanese yen. That was a very interesting point. Some very cool articles came out last week about that, which was exciting for those that are fun Wall Street Journal readers. And also commodities. Think about those precious metals. Think about those agricultural products. You hear people talk about soy and grain and corn and all those types of things. Well, this specific type of non-correlating asset that we're talking about here, they'll float around all of these different categories and they'll say, you know what do we think is undervalued today as a category? And what do we think is overvalued today as a category? And instead of getting on the bandwagon and saying, hey, these things tend to be charging right along, we're just going to jump on that wagon and we're going to ride that train. They would say, if we think something is valued lower than it should be, because it's not popular, it's not perhaps the flavor of the week, well, we may want to buy into that and sell it in the future at a higher price. So they call it going long, or you're betting on that increasing in the future, and so you play the up game on those. And some of the investment options on this wheel that you're looking at, like, ooh, those are a little hot. We think they're overpriced today, and we think they are going to regress down to that mean, as Don was saying earlier. They'll enter contracts and say, hey, we're gonna sell that. We think it's going to go down, so we're going to bet on that one decreasing in the future. And they'll ride that wave across this entire wheel and say, hey, we're betting on certain things growing and certain things falling based on where valuations are today. And what they're hoping is that they're going to not just mirror what the markets are doing, but they're going to weather through those different market cycles across different trends that occur. I love this next slide. It shows you, here you can see many of the trends that we've experienced in the US economy since the mid-90s, the dot-com bubble, both the bubble itself growing in the late 90s into the early 2000s, and then the crash of that, right? In the early 2000s, the housing bubble that was growing. Housing spiked 2004, 5, 6, 7, 8, right? And then it crashed off, and 2008 to 2010 was a challenge. So when you look across these periods, different systematic trends were realized in the marketplace. But what this little blue line here is it shows the performance of that stock, shows the performance of that product. Sorry, not stock, this non-correlated product. And what do I see when I see a line like this? Well, I see that when the market did super well in certain periods, it kind of chugged along, didn't really, kind of was level. And when the market tanked in certain periods as a whole, it chugged along, right? And so what this is saying is, hey, this doesn't perform like the equities market. This doesn't perform like the true bond market. This is going to act differently in those environments and will help balance the portfolio out in moments where things are a little erratic. And that's the kind of non-correlated performer that we're looking for. If you looked at this in 2019, you would say, golly, the stock market's been going up really, really well the last 5 years. This product isn't doing so well. Well, if you looked at this product over the last 2 weeks, you'd be like, why didn't I own more of this product when the market was going down for a couple of days? This product was doing great. So that's what it's in there for. It's in there to help us kind of lose less in some of the more volatile seasons. And then it does slow the portfolio a little bit on the upside, but they are looking to continue growing. You'll notice from left to right, it is a growing product overall. So those are the kind of non-correlated examples that we're looking for, that we think build a really nice balanced portfolio that can bloom in a variety of different seasons, to Don's story there. So that's kind of the example for non-correlation. Don, anything else there?
No, but before you go into the product that we've added relative to alpha, let me just make a more general comment that historically, I've always desired to bring more institutional kind of money management thought to our average American clients. And so this idea of what's termed alternative assets has always been a part of what I've done. If you look at, when you've been in the office here, we look at what's called a drift chart. It's basically the pie chart over time. I've frequently had 20 to 25% exposure to alternative, non-stock, non-bond investment products. Jansen comes from an institutional background. I know that right now the average institutional portfolio has close to 50% of alts in it. When you were managing and overseeing the large $30 billion portfolio, what portion of that was actually in alternative kind of assets?
Yeah, if you include private placements in there, we would range anywhere from 40 to 55%. Alternatives making up at least a third of our portfolio all of the time. And then depending on, we also utilize, when you have a $20 billion pool that's invested in publicly tradable things, and then 10 billion that's in private things. In that public space, we also, not only did we kind of slide amongst the different asset classes over time, but that dovetails very nicely into, we had a mix of broad exposures that were very inexpensive. We like that. But also where in places where there's a lot of volatility, or in places where it is proven that research allows you to make better bets if you're actively managing things. Think day trading, think choosing on a regular time base to change the portfolio construction. We had a lot of exposure to, we had about a 2/3 passive broad exposure and 1/3 active exposure, which is where that active management piece is coming into play, which is where we're kind of heading next. So always this idea of sophisticated institutional style quality, and then building those portfolios for regular or for American households, is an idea that I'm deeply passionate about. I know Erik is deeply passionate about. He runs some of his own portfolios as well, and is very actively participatory in those strategies also. So happy to kind of get into some of this conversation around what is the difference between passive investing versus active investing. Won't spend too much time here. And really, this slide is not about the pie charts. They can be tricky to read. But the idea is, yes, of course, we always want to diversify. You hear that term all the time. And most of the time when we think diversification, we want, you want some large stocks, some medium-sized company stocks, some smaller company stocks. You would like some bonds. You might want some currencies, those types of things. That is diversification based on the different assets that you have. You can also diversify based on the different investment strategies that you have in an investment portfolio. In this example here, this whole pie is based on different asset classes. The representation over here is this whole pie is the dark blue. Asset allocation is what's driving that portion. And then we use a couple different strategies as well. It's good to diversify not just on what assets you're investing in, but in the strategies that you're investing in. And here is where we would say, for this pie, this is all representative of kind of passive broad investing. Here we like to incorporate some active management where it's both cost effective and also proven. Investment managers that are able to look at market factors and be able to float in and out, make daily decisions on how their portfolios look. That can also kind of balance and weather some storms in volatile markets. I love this look here at one of the products that we invest in. This is also in the portfolios today for Stewart and Simmons clients. You can see that they're exposing that, they're building their investment product with equities, with fixed income, and with alternatives, very similar to the things that we use to build our portfolios. But look at the ranges. They may have 0 to a 40% exposure in equities. They use a little bit of leverage, as Erik was mentioning earlier. So they may have a 0 exposure to fixed income on one day, and they may have a huge exposure to fixed income 2 days later, similar to alternatives. And they do that, and they flex based on economic indicators to hopefully kind of create a smoother ride over time. This next slide, I think, is super beautiful explanation of that. There's a lot of color here. So forgive the color, we'll explain. And the point isn't necessarily what the lines are. You think of the pink and the yellow ones as fixed income kind of credit products, think bonds. Alternative exposures, we talked about that. That's in green. Equity is in blue. But look at the zigzagging, right? Over a period of time from 2006 all the way to present, you can see how they're drastically changing on a regular basis, the ratios of those holdings that they have in their portfolio. And why would we want this in a portfolio for Stewart and Simmons clients? Well, look at this nice little black line. This is kind of how that product is performing over time. Look how smooth that is. Look how, it's in the big up periods, you're not getting that big up. But in the down periods, you're not getting a down either. It's a nice leveler. It helps kind of dampen that volatility, that high up and that low down, and kind of ride some of those waves as a leveler. So these are types of things that when you have active managers that are changing the composition of their investments on a regular basis, based on very established and proven methodologies that they have shown good discipline and exercising over time, it can really add a lot of quality to a portfolio, reduce the amount of risk, help balance that ride out a little bit in markets that can be kind of high and kind of low in different seasons. And this is just a nugget for fun. Where we can invest and also be impactful, we love that 1-2 punch, right? And the neat thing about this product that we've included in our portfolio that I think is really beautiful is they made a decision that their management company was doing very well for itself. And so when they created this product almost 20 years ago now, they made the determination that all of the management fees that they would earn from investing this product, creating this product and having it in portfolios, they're going to give it all to charity. So over the last, I think it's almost 20 years, they've generated $13 million in charitable giving that they've given to microfinance organizations, medical charities, leadership trainings programs, domestically and internationally. It's good for our portfolios. The math is there. And also they choose to take some of the fees from that product, all of the fees from that specific product, and invest it in charitable outcomes. That's a really exciting 1-2 combo that we're really excited to have in our portfolio. So here you can kind of see these building blocks of saying, yeah, we want broad exposures. We want to thoughtfully kind of deviate from the norm in specific areas. And we want to not just passively invest, but we want to invest sometimes actively that shifts the portfolio regularly to help us kind of smooth out some of those different market environments. Hopefully that was clear enough. Don, would you have anything to add to that?
I think that's great. The only thing I'd like to see on that previous slide is an overlay of the S&P 500, because, especially if you looked at 2020, where this thing went up, that's where the stock market went down 40%. So, that's why we have this in the portfolio. We just increased our position in it I think right around July 20th, before the market kind of started to do its drop. We peeled off 10% from our large cap stock and started to allocate it to this alternate investment strategy and the low correlation strategy. So as Jansen said, it looks good over the last couple of weeks. We had favor in terms of the timing of when we did it. I did have one very astute client come in last week. He had seen the changes in his portfolio, and he had the 1-year returns on the new things that we invested in, and they weren't nearly as good as his large cap growth. He said, Don, what are you doing? Why are you buying these things? They haven't performed. I said, well, if you believe in what I'm saying about low correlation and adding alpha, that is exactly what we're doing. The first rule of investing that I learned when I was very young: buy low, sell high. So we've been selling stocks, which are at all-time highs, in order to buy some of these things that just haven't trended very well over the last year. We're buying them at low prices. So that's my summary. Oh,
You won.
yeah, this is, I think, our last slide. This was something I just threw on a spreadsheet yesterday because I wanted to illustrate this point. Basically, the lesson to be learned is that losing less matters more than average return. And most investors don't really get this, but there's simple math to it. So I just looked at, we've got scenarios there. Let's call them portfolio 1 and portfolio 2 with 5-year performance numbers. Scenario 1 loses 45% the first year. Scenario 2 loses 20%. And then you can see over the next 5 years, scenario 1 actually performs better every year than scenario 2. But when you tally it up and average them out, they each come out with a total return of 10% for the years, or an average of 2% per year. That's how most people do the math on their portfolio. They want to know, what's the average rate of return been? Well, the average rate of return really doesn't tell the whole story, because if you do the actual math, if you start with $1,000 and you lose 45%, like some people did in 2022, you're now down to $550 on that $1,000 investment. Scenario 2, you lose 20%, you've lost $200. But even though scenario 2 doesn't get the stellar upside returns, look at how it compounds. And by the end of the 5 years, your ending real rate of return is basically 0% on scenario 1, 1.3 on scenario 2. So the lesson that I just want to point out here is that losing less matters more than your average return. So we will always continue to try to manage things in a more, less volatile fashion, if you will. We call it standard deviation. We want more predictability on our returns, because I really believe that in the end, the tortoise does win the race, that sometimes it's okay to go slower as long as you're not going backwards. So that's I think, my summary for tonight. I think we can open it up for some questions. And I don't seem to have the place where people can type in questions. Zach, since you're the host, do you have that? Do you have the chat? Oh,
yep, we can. There is a chat function. It looks like we have 22 participants or so. So it's a smaller group. If you care to just come off chat and ask your question, you're more than capable and willing and encouraged to do so. Or if you'd like to type it into the chat, please do so as well. That's perfectly fine. I'll be monitoring the chat.
Gotcha. Yep. Go ahead.
Yep. Sorry, too many settings. In the strategy of active management, I think historically, there was a lot of active management, going back. And then there was this whole sort of in favor of ETFs and full automation and driving all the cost of active management out. And that, active management was a bad thing. It was killing our returns over time. And, it's a little hard for me to pivot back into this idea of when is it really good to do active management? When do you really need to have somebody watching it, and that the juice is worth the squeeze in terms of providing that? Can you talk to that a little bit?
I will, and then I'll let Erik also join in. I've been in this industry since 1987. So back in that day, there was nothing you could do that didn't have a high commission attached to it. There were various products that carried as much as a 10% commission to buy into them. In fact, the guy who hired me and mentored me said that when he started in the 1950s, the products he was selling had a 30% commission. Well, now most advisors have gone to fee-based, fee-only, which we did back in 1992. I think we were the third firm in the Capital District area to actually go to fees rather than commissions. That being said, the argument is that, and I said it earlier, that everything reverts to the mean. So, why not just be in an index fund? And that most active managers don't outperform the index. But the reality is most don't, but there's about 25% who do. We have the ability to do incredible research and identify 1 out of 4 investment managers that actually are doing something that beats the market. So our strategy has always been use indexes for the core of the portfolio, use asset allocation for the core of the portfolio. That's typically been 70 to 80% of our portfolio. It's just been the last couple of years where, at least at Simmons, things were far more indexy. And now is an opportune time to start getting back into the alternatives. It's been hard to beat the S&P 500 the last 2 years. Even if you were in an equally weighted portfolio of those same 500 stocks, you got, about a 7% return instead of about a 25% return. So it's a combination of both, in my opinion. Erik, how about you?
Well, Tom, great question. So it's certainly the case that the active passive debate is one that is widely commented upon. There's a lot of publishing about it. Morningstar has a regular quarterly, or it's a maybe semi-annual update to this active passive question. And what you usually find is in more thinly followed, an asset class that has fewer analysts following it, the greater the reward there is to an active approach. It's also the case that, and so which are the most widely followed asset classes? It's large cap US. So indexing large cap US, especially on the growth side, probably is an arguably strong strategy. Although, as Don pointed out, some of the active large cap growth managers that are in the Stewart Simmons portfolios are exceptionally good at what they do, especially if you measure it on risk-adjusted returns, not just raw returns. I know you can't eat risk adjustment; you can eat returns. If you have only one and only one element in your portfolio, but a risk-adjusted conception or a reducing risk for equivalent or near equivalent returns allows you to have, for the same overall portfolio volatility, a slightly higher equity exposure. And that's the result may be that the portfolio level return is stronger precisely because you've been able to, with your risk budget has allowed you to go a little bit higher on the equity sleeve. So where though, it is not only location by assets, it's also location in time. When markets are behaving in a really concentrated way, by that I mean there's very little dispersion of returns, there's super high correlation, passive wins. When there's dispersion in returns, active wins. And generally speaking, active management is strongest in international markets and emerging markets. Less useful in the U.S., but clearly useful even in the U.S. when you have dispersion. We are entering a period of dispersion. So on that basis, I believe this is I don't have a what are the dog in this fight. All I'm saying is that it does feel like this is a time when active is actually being rewarded. By active, looking for high quality, looking for attractive valuations, looking for momentum, looking for free cash flow growth, and being selective about what you own. It seems to be this seems to be a moment where that sort of thing is being rewarded.
Thanks for the discussion.
Yeah, the only go ahead, Dave.
Don, and it could be any one of you guys that can answer this, but Don, since I have you, I'll ask you. I'm curious the way you think about portfolio construction. If someone is interested in over time increasing the percentage of their portfolio that are in private alternatives. So let's assume we want to get up to 10 or 15 or maybe a higher percentage. Does the rest of the portfolio, let me just use 10 to make it simple, does the other 90% just look like it, same as if we're 100% portfolio invested in your normal strategy given our risk tolerance? Or do you change something about the 90% because you have 10% in private alts? Does the question make sense?
Great question. I would start actually with the financial planning side of the conversation in terms of sufficiency. And do you have the sufficiency to allow for the added risk that alts may provide, or private placement things? So from that standpoint, that's the first place I start. And then the second question is, okay, if we're going to reduce the publicly traded piece in favor of privates, where are we going to take that from? And that also goes back to a financial planning question of what is the level of income that you need? So what do we need to continue to have in the portfolio to provide that level of income? And just like Erik said, you can eat returns, but not risk-adjusted returns. I know that you can eat capital gains just as well as you can eat dividends. So it doesn't mean that we have to move all of our stuff into income-producing investments either. I don't know that I completely answered that, but I'm going to give it to Erik to complete my answer.
Well, David, great question. My view is it varies a lot by what alt you're talking about. So if you, Jansen like that, I'd love to hear Jansen's follow up on that.
Jansen would like me to answer that question too, but I told him, give me another week.
No, yeah, that's right where I was going, Erik. And when we, I'll take us back to my former role. We increased our allocation $1 billion to real estate 1 year that I was there. And you're like, wow, that's a lot, right? But then when you dig into real estate, not all real estate is created equal. So it very much depends on what it is that you're going into. You may have a portfolio. This is adding on to the planning conversation because cash flow is super important consideration. But you may have a portfolio and you may say, I have no exposure to multifamily real estate. And if you're adding multifamily real estate to a portfolio, that's an entirely new asset class. And so that won't necessarily, it will shrink the publicly traded portion of your portfolio total investment dollars, but it actually helps build out the diversification of it because it acts differently. Now, if you're buying into private equity and let's say an earlier private equity when companies are a little bit younger, boy, that's pretty risky stuff. That's a very, think of that as kind of a large cap comparable. There's going to be some swings there. You got to be willing to weather some storms. And so you may choose, because you're adding more horsepower to a riskier asset class, you may choose to downgrade your volatility or your risk appetite with the remaining portion. So it really very much depends on what specific private asset class are you looking at, and what are you seeking to accomplish with that asset class? To some, it might be a great additive, and we wouldn't change the rest of the pie necessarily. To others, we would say, yeah, if you're going to go there, that would impact what risk adjusted model we would invest you into.
Okay, super.
Erik, what do you have? Anything beyond that?
We just think of it as the classic 2x2 table. So if you think on one dimension is volatility, another dimension is liquidity. The lower the volatility, all else being equal, the lower the volatility and the higher the liquidity, the more I think it permits the rest of your conventionally allocated portfolio to push more ambitiously in the direction of growth. Conversely, the more volatile or less liquid, the more you ought to have liquidity options within your portfolio, so that if you do need to tap liquidity in a downturn, you're not stuck.
Yeah. Great.
Excellent question, David.
Yeah, very good. Well, I hope that this was helpful for everybody. We've chewed up almost an hour and a half of your evening. Thanks for being with us. We try to do this a couple times a year, if for no other reason, just to share what we're thinking. But this turned out to be an opportune time because a lot of people had questions about what we were thinking about the recent market volatility. I can tell you that this didn't come to any of us as a surprise. This was something that we anticipated. It's a normal part of the markets and how they perform. And we really believe that we're in the right positions to take advantage of this and to get the best risk-adjusted returns for our clients. So thank you for the confidence that you've placed in us. We take it seriously that we are stewards and fiduciaries of your resources as we help you to steward them well for yourselves and your family. And we just thank you for doing it with us. I think that we're recording this, and after it's cleaned up for compliance reasons, if you want a copy of it, just send us a quick email and we'll get you a link to be able to use it.